New to crypto? This video is a game changer for beginners. Don't fast forward, you'll miss crucial info. Gain insights that can save you countless hours and thousands of dollars. Discover strong fundamentals for better odds of success, combining long-term strategies, market downturns, swing trades, and profit-taking. Patience and conviction are key. These virtues will enhance your crypto journey. Watch now and transform your approach to crypto investing. Remove emotion from the equation. Do not FOMO, fear of missing out. Never invest more than you can lose. In the dynamic world of cryptocurrency trading, success often eludes those who seek quick gains through frequent buying and selling. For beginners aspiring to build a profitable portfolio, the mantra, buy low, hold long, proves to be a time-tested and reliable approach. Seasoned crypto traders understand the importance of patience. Buying low and holding for the long term allows investors to weather short-term market fluctuations and benefit from the overall upward trajectory of the market. Cryptocurrencies, known for their volatility, can experience significant price swings in the short term, making a long-term perspective a strategic advantage. Smart investors capitalize on market downturns by employing a strategy known as cost averaging down. When prices dip, instead of panicking, consider it an opportunity to accumulate more assets at a lower cost. This not only reduces the average cost per unit, but positions the investor for greater returns when the market inevitably rebounds. Consider this scenario. You initially purchased 1,000 coins at an average price of $1 per share. Later, when the market dipped to 70 cents, you decided to buy another 1,000 shares. This effectively lowered your average cost per share to 85 cents. Now, with the market at 70 cents, you would only need about a 22% increase in price to break even. However, if you hadn't averaged down, it would require about a 43% increase in price to reach the original $1 purchase cost. While averaging down involves investing more money, the potential risk diminishes if you've conducted thorough research and have confidence in the project's quality. Even though an additional investment is required at 70 cents, the reduced break-even percentage and the belief in the project's potential make it a strategic move rather than a high-risk endeavor. Day trading, a strategy where individuals make multiple trades within a single day, may seem enticing but comes with considerable risks, especially for beginners. Shockingly, over 90% of day traders incur losses in the crypto market. The high volatility and unpredictable nature of cryptocurrency prices make day trading a perilous endeavor. Facing off against highly skilled and resourceful opponents armed with cutting-edge technology puts you at a significant disadvantage. Beating smart money is undoubtedly a tough challenge. They are the masters of manipulation. On Wall Street, the smart money operates like a lion patiently waiting in the bushes, ready to ambush unsuspecting prey. Your task is to navigate away from danger. With air hoses thicker than yours and an ability to hold their breath longer, they suffocate the impatient and weak-handed investors. Equipped with behavior algorithms, they counter your every move, scrutinizing your limit, stop limit, and trailing stop orders. The savvy players on Wall Street manipulate the news to orchestrate artificial market pumps, capitalizing on retail investors. They go to the extent of hiring shills and intellectually dishonest influencers to manipulate opinions. Expect the use of smoke and mirrors tactics and misdirection. Remember, you're on your own. Regulators like the SEC, CFTC, DOJ, FinCEN, FinHub, or FTC are not necessarily on your side. Government regulators may not intervene, and those who control the mainstream media dictate the narrative. Stay vigilant. Consider joining a local investment club or an online investing community, just as Warren Buffett did when he began his investment journey. Explore platforms like YouTube and Twitter to find credible influencers. Their insights can save you countless hours of research. However, never solely rely on others. Take the initiative to conduct your due diligence, understand the intricacies of your investments, and stay updated with news on both macro and microeconomics regularly. Get involved in the process. Practice with a play money account, sometimes called a paper money account, readily available on many exchanges to gain practical experience. This hands-on approach will provide valuable insights and open your eyes to the dynamics of the market. Success in the crypto market hinges on knowledge. Conduct thorough research on the projects you invest in, understanding their technology, use case, and market potential. Stay informed about industry trends, regulatory developments, and macroeconomic factors that could impact the market. Informed decisions based on sound research are the bedrock of a successful investment strategy. Technology empowers investors, and utilizing portfolio trackers is a key aspect of managing a successful crypto portfolio. These tools provide real-time insights into your holdings, enabling you to make informed decisions based on current market conditions. By tracking your assets and their performance, you can adjust your strategy as needed, ensuring your investments align with your financial goals. Use crypto tools such as token metrics to dive into the expansive realm of cryptocurrency data using the Token Metrics Data API. It's crafted to offer you effortless access to up-to-the-minute market information, analytics, and insights. Elevate your decision-making and application development with this comprehensive tool. As crucial as the buy low, hold long philosophy is for crypto beginners, knowing when and how to sell is equally pivotal in building a successful investment strategy. Here are 3 effective selling strategies that can help investors optimize their gains and manage risks. The first strategy is the simplest and easiest form of investment. Patiently await a downturn in the cryptocurrency market, then invest your funds and adopt a long-term holding strategy. If the market continues to decline, consider employing a cost-average down strategy. Newcomers frequently fall into the trap of chasing surging prices and purchasing assets at their peak. Seasoned investors, however, adopt a strategic approach by capitalizing on both upward and downward market movements. Yet, in this beginner's course, we'll focus on the fundamentals and keep things simple. Market downturns can occur at any time, often triggered by economic factors, market sentiment, regulatory changes, black swan events, global economic situations, overvaluation, etc. As of December 10th, 2023, the current crypto cycle presents outstanding opportunities with projects trading at more than 90% below their all-time highs. This represents an exceptional investment prospect. Manna from heaven. As an illustration, suppose you evenly invested in 3 assets at a market price of $1 each, resulting in a total purchase cost of $3,000. After 90 days, investment A maintained its value, trading sideways at $1.01, while investment B declined to 90 cents and investment C dropped further to 85 cents. You've gathered $1,000 for investment. While there's the option to explore a different project you've been considering, you opt to stay with your initial 3 investments. Your decision is rooted in thorough due diligence, and you have confidence that these investments will yield positive returns in the long term. No need for panic, right? What should be the allocation for each investment? There are no incorrect choices if you decide to invest more capital in investment B and/or C. Determine your allocation based on the latest news and updates. Identifying the peak value of an investment poses challenges, and there's no guaranteed method. Nonetheless, it's advisable to avoid greed and consider securing partial profits. These are fundamental strategies and principles that investors should keep in mind. This approach guarantees profit security, enabling you to at least recover your initial investment. In the crypto realm, it's not unusual to witness returns of 3x, 5x, or 10x, particularly in the midst of a bullish market season. With an impending bull run, there's a significant opportunity at hand. Search for other investments that have not moved. This is your golden opportunity to reinvest. Consider having a plan for reinvesting profits or redistributing assets into existing or new opportunities. Let's look at another strategy. Adopting the 75/25 rule involves dividing your portfolio into two segments: 75% for long-term holding and 25% for strategic buying, selling, and reinvestment. Research reputable projects and identify their historical all-time highs. Look for projects showing a substantial drop of over 50% from their all-time high, indicating a potential buying opportunity. Calculate the percentage drop from the peak to the current price and reinvest the 25% in these undervalued tokens, leveraging the potential for future growth. Here's a helpful tip for everyone. Go to coinmarketcap.com, a price tracking website that can automatically calculate from all-time highs. Select the coins you want to follow and click to add them to your watch list. Go to Customize, select from 8th, and move the position from 8 to 7. This will allow you to see the From Ath on the main menu. Select Watch List, and you will see the coins you picked by order of market cap. Keep it straightforward by choosing no more than 12 to follow. Opt for the top 6 or fewer for your initial investments. The remaining 6 can be considered for future investment, either from reinvested profits or capital savings. Allocate 25% of your investment into undervalued tokens, capitalizing on their potential for future growth. Execute strategic selling to take profits, allowing you to reinvest in projects that have not experienced significant movement. Alternatively, consider moving some profits to acquire additional coins for your long-term holdings. If you don't have any time to study and learn crypto strategies, take a course, or learn technical analysis, then copy trading can be a viable option for beginners. Advantages of copy trading. Copy trading allows beginners to engage in trading without an in-depth understanding of the market by replicating the trades of experienced and successful investors. Copy trading reduces the time and effort required for market research and analysis, making it more accessible for those with limited time. It provides an opportunity for beginners to observe and learn from the strategies and decisions of more experienced traders. Here are some considerations. Relying on the decisions of other traders means beginners may miss out on the learning experience that comes with making independent decisions. While copy trading can be less complex, it doesn't eliminate the need for risk management. Beginners should still be aware of the risks associated with cryptocurrency trading. Some copy trading platforms may charge fees or commissions. Beginners should be aware of these costs and factor them into their overall trading strategy. Our third and final strategy: build a diversified portfolio with a balanced approach using the 66-33 rule. Allocate 66% of your portfolio to long-term investments, providing stability and steady growth. Allocate 33% of your investment simultaneously to other technology segments, including precious metals like gold and/or silver, effectively diversifying into the metals and mining sector. Additionally, consider diversification into technology sectors such as AI, 5G technology, biotechnology, and clean energy technology for a well-rounded investment approach. This strategy can be used when you want to take advantage of early developments in the technology sector. Like any emerging technology, investing in AI carries risks. These may include regulatory uncertainties, ethical concerns, and the potential for rapid changes in the competitive landscape. You've gathered $1,000 for investment. Strategically diversify your investment by thoughtfully allocating your $1,000. Start by investing 1/3 or $333 during a market downturn in your existing portfolio. Exercise patience, anticipating potential further price drops. Remember, smart money is watching you. Seize the opportunity to lower the cost average by investing an additional $333 if suitable. After the price stabilizes, the last third of $333 can be used to either continue cost averaging down or reinvest in your long-term holdings. What if the market takes a positive turn and starts rising? Congratulations! Now that you're in a profitable position, The choice of whether to bolster your existing investments or explore new undervalued opportunities is entirely yours to make. The goal is to identify lucrative opportunities, make strategic trades, and reinvest the gains back into long-term holdings. This method allows you to capitalize on short-term market movements while steadily accumulating assets for the future. A wise approach when in profit is to withdraw your initial investment. By doing so, you're essentially playing with the house's money. For instance, let's look at an example. If you initially invested $5,000 and a year later, through some fortunate outcomes, your investment grew to $12,000, you have the option to withdraw the initial $5,000. Subsequently, you can choose to retain the profits or utilize the gains to invest in other projects. A blend of the aforementioned selling strategies can be integrated, recognizing that everyone's approach is unique. It's entirely plausible to adopt a hybrid strategy that combines elements from various methods to suit individual preferences and risk tolerances. Incorporating these selling strategies into your overall investment approach can enhance your ability to navigate the dynamic crypto market successfully. Remember that each strategy comes with its own set of considerations, and it's essential to align your selling decisions with your financial goals and risk tolerance. By combining prudent buying with strategic selling, you position yourself for a well-rounded and resilient crypto investment journey. Remember, there are tax consequences with the sale or exchange of your crypto. Taxable events. Exchanging one cryptocurrency for another is considered a taxable event, and you must report any resulting gains or losses. Cryptocurrency as payment. Using cryptocurrency for goods or services is also a taxable event, with gains or losses calculated based on the fair market value at the time of the transaction. In many jurisdictions, the FIFO first in first out method is commonly used to determine the cost basis when selling specific units of a cryptocurrency. Short-term gains occur when you hold a cryptocurrency for 1 year or less before selling. Short-term capital gains are typically taxed at your ordinary income tax rates, which can be higher than long-term capital gains rates. Long-term gains occur when you hold a cryptocurrency for more than 1 year before selling. Long-term capital gains often receive preferential tax treatment, with rates that are typically lower than ordinary income tax rates. Capital losses can be used to offset capital gains. If your capital losses exceed your capital gains, you can use the excess losses to offset other income, subject to certain limitations. If your capital losses exceed the allowable deduction for the tax year, you can carry over the excess losses to future years. In conclusion, for beginners entering the crypto market, a patient and strategic approach is the path to success. Embrace the philosophy of buying low, holding for the long term, and taking advantage of opportunities presented by market downturns. Avoid the pitfalls of day trading and prioritize research, using portfolio trackers to stay on top of your investments. By adopting these principles, you position yourself for a more secure and profitable journey in the exciting world of cryptocurrency. Kindly consider liking and subscribing to Utility Coin Central. Check the description below for sponsored affiliate offers. Thank you for supporting